If you know me, you know that this is a topic that fires me up. We're going to be breaking down the truth about how LLCs actually work. There's a ton of myths and misconceptions around LLCs, making them seem like this magical tax savings vehicle. But we're going to break all that down today. You don't want to miss it. Welcome back, guys. If it's your first time here, my name is John Boyd. I'm a certified financial planner. I'm the founder and lead wealth advisor at Modern Wealth. We're a fiduciary fee-only financial planning firm located in Scottsdale, Arizona, but we serve clients all over the country. If you like today's content, be sure to hit that like and subscribe button and share it with a friend. So over the last couple years, I've noticed this trend of, all the TikTok, YouTube financial influencers being obsessed with LLCs, right? Telling everybody that you need to set up some LLC, that you need to, create this magical strategy to pay yourself some management fee and avoid taxes, right? I mean, there's tons of different videos on this particular topic, and they drive me nuts. Some of the guidance out there is flat out wrong, and some is borderline fraudulent. So what we're going to do today is break it all down. We're going to talk about what an LLC is actually for and some of the myths around it. And we're going to do that by breaking down 3 key things that you need to know about LLCs, specifically in the context of business and real estate. So before we dive into it, I want you to stop for a moment and think about what's the first thing that comes to mind when you think about an LLC, right? For a lot of people, that might be something tax related. I need to set up an LLC because it will save me on taxes, right? A lot of people tend to think LLC equals tax savings, and that's just simply untrue. Just because you have an LLC, it doesn't entitle you to any sort of special tax benefits, unless you're trying to make an S-Corp election, which will be a discussion for a different time. But in general, an LLC gives you 0 special tax benefits at all, right? So get that out of your head. So the first thing that you need to know about LLCs is that you set up an LLC as an asset protection strategy. It's not a tax strategy, it's an asset protection strategy. What an LLC does is that it divides your personal assets from your business assets, so that in the event that you are sued, right? Let's say that you set up a business and you get sued. Well, your business assets would be divided from your personal assets. So if you had, let's say, $1 million in personal assets, well, then those assets would be shielded in theory in the event of a lawsuit. So that's the reason why you would want to set up an LLC, and why in many cases it makes sense to set one up in the context of setting up a business and with real estate is to provide that asset protection. However, from a tax standpoint, it makes 0 difference. If you tomorrow decide to set up a business and you start making money, by default, you are going to be a sole proprietor, meaning that you can go ahead and deduct your losses on Schedule C. You can set up a solo 401k. Nothing changes. If someone were to be a sole proprietor and set up an LLC, the taxation, all of that would be identical. There's no special tax treatment. And that blows a lot of people's mind, because people think that setting up the LLC is the ticket to all these tax savings. And that's just simply untrue. An LLC is an asset protection strategy. When it comes to understanding how your business will be taxed on the state and even federal level, the second thing that you need to know is the concept of physical and economic nexus. So physical nexus is pretty easy to understand. Do you have a physical presence in a specific state? Do you live there? Do you have offices there? Do you have employees there? Right? That is one easy way to to determine what state your business and even personal taxes will be subject to. So what this means is, let's say that you are a California resident and you are a solo business owner doing business in California, and all your sales are there. Your office is there, your people are there, etc. But you set up a virtual mailing address in the state of Florida to try to claim that you are a Florida resident. Is that going to fly from a tax standpoint? Right? You guessed it. The answer is likely no. If you try to avoid paying California taxes in that case, California will very likely come after you for not paying California state income tax. And the reason for that is that you have physical nexus in the state of California. Now, let's say that you are a Florida resident. You live there, you have your office there, you move there for state income tax purposes. However, let's say that most of your sales volume is done back in California. Well, if that's the case, California could certainly still claim that you owe income tax to them based off the principle of economic nexus. Economic nexus is a relatively new concept that is backed by a 2018 Supreme Court ruling. But essentially, this concept addresses how you would pay tax in this world that we live in, where people do business all over the place because of online presence. Just because you physically live in one state, but you do all your business in another, doesn't necessarily mean you're off the hook from paying that state their fair share in taxes. So bottom line, guys, it's really important to grasp that concept of physical and economic nexus, because again, one of the misconceptions that's constantly going out there right now is that because it's so easy to set up an LLC in another state, that is a ticket to avoiding state taxation if you live somewhere with high taxes, or heck, even trying to avoid federal taxation, right? It's just very likely not going to fly. The third thing that you should know about LLCs in the context of real estate is that LLCs are generally a great idea to protect yourself with rental properties that you have, but it doesn't change anything from a tax perspective. And in fact, it actually might have negative tax consequences to you, which we'll break down in just a second. So again, a lot of folks get their first rental property and they think they need to set up an LLC right away for tax reasons. And that, again, just simply is not true. Even if you put that property in an LLC, you would deduct rental expenses on Schedule E. You could still claim depreciation every year. Nothing would change from a tax perspective. Again, it's generally not a bad idea to put a rental property in an LLC purely from an asset protection standpoint, because let's say that there's a major leak and all your tenants' stuff gets damaged, maybe they get hurt and they want to sue you for negligence, right? Having that property in an LLC could provide a lot of protection from a legal standpoint. However, I mentioned that an LLC could potentially have negative implications from a tax standpoint with real estate. And what I'm referring to is the capital gain exclusion on a primary home. So this is something that I see all the time. Let's say that you lived in home number 1 as your primary residence for 5 years, and you decided to upgrade and buy home number 2, and now home number 2 is your primary residence. Well, if you place home number 1 in an LLC right away, but then a year later change your mind about being a landlord, that maybe it's not for you, it's too much work, and you sell that property, well, now that capital gain exclusion of $250,000 for an individual and $500,000 for a married couple on a primary home, well, now that capital gain exclusion goes away because you transferred that property into an LLC. So again, I can't stress it enough. From an asset protection standpoint, yes, it generally makes sense to have a rental property be in an LLC. However, if this was your primary home for 2 out of the last 5 years, and you're thinking that you might sell it, and there's a lot of embedded unrealized gains in that property, I would think twice about shifting it to an LLC right away. You better be darn sure it's going to be a rental forever, because if you change your mind, you could be jeopardizing that capital gain exclusion. So there you have it, guys. Those are the 3 key things that I want you guys to know about LLCs. If you're still feeling overwhelmed with this concept, you need more advanced tax planning, entity structure review, whatever it may be, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. We'd love to help you and your family out. It's been a ton of fun, guys, and I'll see you next time.